What do you do when you have a 10-year yield that from trough to peak in like 3 weeks jumped 39 basis points?
Yeah, which is a lot by these standards. You know, we were just talking earlier about the fact I remember taking out my first mortgage at 9.75% and thinking I was getting a great deal.
3 1/4, buddy. 3 1/4.
So we're dealing with a whole generation of people here who have no idea what a higher cost of capital means, but we do know what it means to bondholders. It means losses when rates go up. Now, you've got the Fed obviously on a tightening path here. You've got Fed funds at 1 1/4 already. Term LIBOR pushing 2%. What makes you interested in buying a 10-year at just over 2% in that environment? I don't quite get it.
But the 7-year auction yesterday was very strong.
Oh, absolutely. I mean, you keep doing it until it stops working, right? It works until it doesn't. And usually when the Fed is tightening and engaging in QT, not QE, quantitative tightening, usually not the best time to get heavily involved in long-duration assets. But the money flow would tell you otherwise. People are pouring into fixed income funds at a record pace. They're pouring into extended sectors like emerging market debt, which is very, very sensitive to interest rate rises, as we've seen over the past week, and pouring into high yield, which is currently trading right on top of the tightest levels, the tightest risk premiums it ever has in history, implying virtually a default rate of almost nothing. So you look at fixed income, and the problem you have now is one of correlation, right? The tighter spreads get in extended sectors, right, the closer you get to zero, the more you end up owning a treasury, right? And the more your entire portfolio ends up being, it's sensitive to only one factor, which is rising or falling interest rates. The problem with people is there's a chronic failure to understand when and how to buy particular parts of the fixed income market. They tend to, if I were a retailer and I put out a sign in front of my store that said, hey, I'm marking up my inventory 30 to 50%. If you equated that to what goes on in fixed income, you'd have a line out the door, people banging to get into the store. In contrast, if I mark down my inventory 30 to 50%, like when high yield spreads blew out in late 2015, 2016, which was not caused by a recession, by the way, it was technical in nature, you'd hear crickets. No one's interested when spreads actually have value. But when the returns are already in and spreads are incredibly tight and the opportunity set has shrunk to almost zero, people are trying to bang their way into these markets. And it happens again and again and again.